So what did Powell say today? What happened at the Federal Reserve meeting? I'm going to sum it all up here in this video. You do not want to miss it. If you haven't caught up on what's going on, if you didn't hear Powell speak, if you haven't heard any of this stuff, you're going to want to see this because big things happened today. Let's dive into it. You'll want to watch this video to the end. Be sure to hit that subscribe button. So the Fed projects raising rates as high as 5.1% before ending inflation battle. You're thinking, they want to raise to 5.1%. Okay, oh, interesting. What's the big deal? Check this out. We're going to get into that. I'm going to show you something as to why that's such a big deal. And let me know in case you didn't know, the Fed today, they raised interest rates by 0.5%. That is literally what everybody expected. What we did not expect was for them to do this 5.1% thing. And it actually gets more hawkish, more bearish than that. Let's dive into this. So today, they announced that they might raise their interest rate to as high as 5.1, where the expected terminal rate 5.1. The forecast before this, at their last meeting, they're saying the projected was about 4.6%. So now this time they come out and they say, we might actually bring it up to 5.1. So the market's like, whoa, because after these two inflation reports that came out, that two in a row that were just like beat expectations, looking fantastic. Nobody expected the Fed to say, yeah, we're actually going to raise interest rates even higher. So in other words, they said, we're going to step on the gas harder than you thought we were, even though you guys thought we were going to let off the gas and do a pivot. Right? Look at this closely. The forecast was 4.6 by the Fed themselves. And now they've bumped it up to 5.1. That's an entire 0.5%. That is over a 10% bump, right? 4.6 plus 0.5, that's more than 10%. They brought the terminal rate where they think they will ultimately bring the interest rate to from 4.6 to 5.1. No one saw this coming, and immediately the markets dumped, and they dumped hard. Let's dive into this a bit more. So like I said, the Fed announced a 50 basis point rate hike today, bringing the borrowing rate, the current rate, between 4.25 and 4.5. We'll call it 4.25. The highest level in 15 years. The highest level since before the last recession in 08. So 15 years ago would have been 2007, right? So the so-called dot plot. Now this is where it gets interesting. This is what you'll want to see. This is what showed us that their expected interest rate is going from 4.6 to 5.1, meaning they're going to bring the interest higher than we thought they were, and odds are maybe they hold it for longer. Check this out. So the dot plot, which the Fed uses to signal its outlook for the path of interest rates, showed 17 of the 19 dots would take rates above 5% in 2023. Now, what are the dots? The dots are people. They're people in the actual Federal Reserve Board. There's 19 of them. 17. I'll show you the dot plot in a second. 17 of them wanted to take interest rates above 5% in 2023. Again, nobody saw this coming because these last two inflation reports were fantastic, right? We went down over a whole percent in 2 months, which beat the pants off of expectations every single time. So we're really picking up pace to go in the right direction. Didn't expect the Fed to come out and say, you know what? We're actually going to put our foot even further on the pedal. What? Anyways, so 7 of the 19 committee members saw rates rising above 5.25 next year. 17 saw it going above 5. 7 of them saw it going above 5.25. Let me show you a dot plot in a second. So for 2024, the rate-setting FOMC projected that rates would fall to 4.1% in 2024, right? A higher level than previously indicated. Also, so when they talk about rates actually falling in 2024, when they actually do pivot, where they expect them to be in 2024, this would be for the end of 2024. Oh goodness, that's 2 years away. This is higher than they previously indicated. So let's look at the dot plot. So here it is right here. This is where we are right now. See, these are 19 dots. 17 of them are above the 5%. See that? Only 2 of them are below, and the 2 below are right at the line. And they're saying, yeah, maybe we do like 4.8, 4.9. So everybody, again, 7 of them believed we should be above. So 5 plus 2, above 5.25, because this is the 5.25 line. And then they think coming out to, look at this, to 2024, they think we'll end up probably somewhere around here, which would be what? Around 4 to 4.425, which is about right in the middle, 4.1. If you add all these up, one person still thinks we'll be way up here. Two people think we'll be way down here. So as you can see, these get pretty spread out. Everyone's in consensus that 17 of 19 of them think we should go above 5. Some of them think we should go above. 2 of them think we should go above 5.5. 2 of them think we should go just under 5 to about 4.75. Both of which are higher than what the Fed put out last time at their last meeting. This is what sent the markets into free fall. Let me show you this. So the historical record cautions, this is Powell quoting. This is what he said in the speech. Historical record cautions strongly against prematurely loosening policy. This is what I was saying on my live streams that Powell was going to come out and say. We will stay the course until the job is done. I literally said he is going to say these words verbatim. He's going to say historical data goes against us prematurely cutting rates, and we're going to keep at it till the job is done. By the way, till the job is done, or some version of that, that's literally the name of Paul Volcker's book, the guy that the most revered Fed chair of all time that Powell wants to be like. The series of rate hikes is expected to slow down the economy. What? Duh. Hit the like and subscribe, by the way. The summary of economic projections from the Fed showed the central bank expected a GDP gain of 0.5% for 2023. So they're not saying there's going to be a recession in 2023. They think it's going to be a very, very tiny growth in market instead of a decline, which is a recession. Again, barely above what would be considered a recession. So, because the Fed cannot come out and say, we expect a recession. They cannot ever, under any circumstances, say that. You get me? So the committee also raised its median anticipation of its favored core inflation measure to 4.8%, up 0.3% from the September projections. So straight up, this was very bearish, very hawkish today. Let me sum this up again. Powell came out, did the 0.5% interest rate hike like everybody thought and everybody had priced in and expected, and they did not expect him to come out and say, we're actually going to raise interest rates for longer and higher than you think. Because last meeting, they said, our consensus is we'll bring it probably somewhere around 4.6%, and that's where we'll probably stop raising interest rates and leave it there to pause. That's the pause. But this time they come out, and after 2 straight very bullish, very beating expectations, very promising, very encouraging inflation prints, right? So we had the inflation report this month and last month. The one that came out in November, which was for October, was expected to be 8.2% inflation. It was 7.7, just busted that. Just bullish. Very good, very strong in the right direction. Then this month it was expected to be 7.3. It came out 7.1. So we've gone down over an entire percent in 2 months, which is like way beyond anyone's wildest best expectations, including the Fed. And what does the Fed do? They come out and they say, we're actually going to push on the gas harder and we like this. We want to make sure that it continues. We want to see if we can get it going even faster, like they're driving a Ferrari. And they're like, I think we got a little bit more pressure to put on the gas. That's what's going on here. So the market's immediately dumped because it is hawkish. It is bearish. Going into 2023, the Fed is just flexing, saying, we're going to bring interest rates higher, and we're going to keep it for longer than you think, market. Just go down, lay off people, send us into a recession so we can drop this inflation. People actually want to get jobs again because they'll have to, and all that demand can go down, and inflation can go down because that's what we need. We need to see 2% inflation. We are not releasing, we're not taking our foot off the gas, we are not slowing down even a fraction of a mile per hour, a fraction of a kilometer per hour until this thing hits 2%. And they're just trying to re-emphasize it over and over and over again. You're going to hear all kinds of people hating this, and they're going to say, wow, the Fed's going to send us into an even deeper recession than we're already headed into. And I can't disagree with that. I cannot disagree with that. This tells me that we're probably not at the bottom. And it also emphasizes my base case, which is this. Hear this. Hit the subscribe button if you haven't yet. Here's my base case. If you go back and look at the data all the way back to 1969, there have been 6 times the Fed has pivoted. Every pivot, meaning they start lowering interest rates. Every single time, all 6 times, when the Fed lowered interest rates, the markets went down, and they went down hard. The least they went down was 27%. The most they went down was 58%. That was in 2008. So when the Fed pivots this time, does it sound like they're going to pivot because everything's going great and they've tamed the inflation dragon and it's back down to 2%? And all right, now we'll loosen a little bit just because we like you. That is one scenario. The second scenario, which I see as much more likely, is that the Fed is forced to pivot, forced to lower interest rates because the economy and the world is burning and they got to bring out their little garden hose and try to put out a raging forest fire, which takes time, right? Because for this fire to get started, it takes time. They've been raising interest rates like crazy, and it takes time for this stuff to work its way through and feel and see the effects. It takes time. I mean, 6 to 9 months, easy. Same thing in the reverse. So once they pivot, it'll most likely be because they're forced to, because everything is in such dire straits that they have to. And the market's not going to go, woo, the world's burning. But here comes the Fed with their little garden hose. Let's ram the markets back up. That's not what's going to happen. There's going to be so much fear and so much panic, just like there has at the bottom of every damn recession/depression that we've ever seen. So the people telling you, wait for the pivot, it's true, wait for the pivot. But that's still not the bottom. That's not going to be the bottom. It's going to be lower than that. Then, once the Fed pivots, then I'll start looking and paying attention, right? Then I'll really start thinking, all right, should I buy this stuff? Because literally history shows us every single time that's the way it goes. When they pivot, that's not the bottom. That is the beginning of the end, though. Usually about 6 to 12 months out from there. So that's what I got for you today. They're crashing and burning us. They're giving it to us dirty. And they seem to, even though things are looking good, they said, well, we don't like how clean this is. We're going to dirty it up even more. Because they're really on that inflation battle. Hit the subscribe, hit the like. Thanks for watching. Take care.